It's the paradox of the American economy in 2025. Inflation is cooling on paper, but for millions of households, life has never felt more expensive. Rent still takes half a paycheck, grocery bills provoke anxiety, gas is quietly back above $4 a gallon in parts of the country, and through it all, the Federal Reserve holds the same weapon it always has: interest rates. But the deeper question is this: can monetary policy actually reach the parts of the economy that are bleeding the most? Or are we watching a central bank fighting a wildfire with a garden hose while the flames of housing, energy and food burn from causes no rate hike can touch? As of July 2025, the Federal Reserve's benchmark interest rate sits at a 22-year high, between 5.25 and 5.5%, the same level it's held since July of last year. The official line from the Fed is clear: we're winning the battle against inflation, but we're not ready to declare victory. And on paper, they may be right. Headline inflation has cooled to around 2.6% year over year, close to the Fed's long-standing 2% target. Markets have stabilized, corporate earnings remain strong, job numbers have not collapsed. But on the ground, the story is very different. Everyday costs for American families are still painfully high, and in some cases, climbing. Rent is at the center of this discomfort. According to Zillow, the national median rent for a one-bedroom apartment now exceeds $1,600 per month. That figure jumps to over $2,500 in New York City, San Francisco, and Miami. In smaller metro areas like Nashville, Tampa, and Denver, rent increases have slowed but remain more than 20% above pre-pandemic levels. Even in places like Tulsa or Indianapolis, historically considered affordable, renters are now spending more than 40% of their income on housing. Meanwhile, gasoline prices have quietly crept back up. In California, the average gallon hovers around $4.10. In the Midwest and South, it's holding between $3.50 and $3.80, with price shocks after hurricane-related disruptions along the Gulf Coast. These increases haven't made national headlines the way they did in 2022, but for families commuting long distances or living in rural areas, the burden is real and growing. Then there's food, the everyday barometer of economic stress. According to the US Department of Agriculture, food prices in June were still 21% higher than they were in 2019. And not just gourmet items or restaurant dining, it's the basics: eggs, milk, meat, vegetables, even bread and rice. A recent report from the Brookings Institution found that over 60% of low-income households are reducing meal size or skipping items entirely just to manage weekly spending. All of this stands in sharp contrast to the messaging from policymakers and headlines about cooling inflation. While the Consumer Price Index, CPI, might reflect slowing growth in overall prices, the core essentials, rent, food, gas, remain stubbornly unaffordable for millions, and the public feels it. A June 2025 Gallup poll shows 58% of Americans say they feel worse off financially compared to a year ago. That's despite a job market that, statistically, is holding steady, with unemployment below 4% and wages up modestly in many sectors. But sentiment doesn't follow spreadsheets. It follows daily experience. And when every trip to the grocery store feels like a financial risk, no economic report can undo that reality. There's a growing disconnect. On one side, the Fed's macroeconomic indicators. On the other, the lived experience of American families. The Fed argues that holding rates high is necessary to prevent inflation from roaring back. But millions of people aren't waiting for the next economic cycle to turn. They're already in survival mode. So the question becomes more urgent. If inflation is technically under control, why does it still feel like everything is broken? And if interest rates are supposed to fix this, what exactly are they fixing? To understand why life still feels unaffordable for so many Americans, even as inflation appears to be under control, we have to examine what interest rates can and cannot do. The Federal Reserve uses interest rates as its primary lever to manage inflation. By raising borrowing costs, the idea is to cool consumer demand, slow down credit-fueled spending, and tame price growth. It's a blunt tool, but historically it's been effective during demand-driven inflationary cycles. But here's the catch. Not all inflation is created equal. The Fed's strategy assumes that the root cause of inflation is excess demand, too much money chasing too few goods. In such a scenario, making borrowing more expensive should discourage spending, reduce business expansion, and ease upward pressure on prices. That worked in the early 1980s. It even worked in the early 2000s. But the inflation America is battling today is structural, not cyclical. And interest rates are simply not designed to fix structural shortages or global supply shocks. Let's start with housing. The US is facing a long-term housing shortage that predates the pandemic. According to a 2024 report by Freddie Mac, the country is still short more than 3.8 million housing units. Construction slowed dramatically during the financial crisis in 2008 and never fully recovered. Add to that rising material costs, labor shortages in the construction sector, restrictive zoning laws, and community opposition to new developments. And you get a housing market where demand chronically exceeds supply. When the Fed raises interest rates, it increases mortgage rates, now hovering around 7 to 7.5% for a 30-year loan. That pushes many would-be homebuyers out of the market, forcing them to remain renters. But the rental market isn't growing fast enough to absorb them. So what happens? Rents rise. In other words, rate hikes unintentionally worsen the affordability crisis by trapping people in expensive rental markets. Then there's food. The inflationary pressure on food is not driven by demand, but by climate volatility, labor constraints, and distribution breakdowns. In 2025 alone, severe drought conditions in California, which produces over a third of the nation's vegetables and two-thirds of its fruits and nuts, have slashed crop yields. Meanwhile, the Midwest has faced unseasonal flooding that's disrupted corn and soybean production. At the same time, immigration crackdowns and a persistent labor shortage in agricultural and food service sectors have reduced capacity from field to shelf. The result? Higher prices for basic groceries, independent of consumer behavior. No interest rate hike can summon more rainfall in California or restore labor to slaughterhouses in Iowa. This is cost-push inflation, prices rising due to supply-side constraints, not something that the Fed's demand-side tools are equipped to handle. And energy prices tell a similar story. Gas prices in the US remain tethered not to domestic consumption, but to global supply chains, OPEC decisions, and geopolitical tensions. The war in Ukraine continues to disrupt European and global energy flows. Recent tensions in the South China Sea have caused oil market volatility. OPEC Plus recently extended production cuts, further constraining global supply. Meanwhile, US domestic refining capacity remains below pre-pandemic levels due to years of underinvestment and refinery closures. Again, none of these dynamics are directly impacted by the federal funds rate. What this creates is a kind of monetary mismatch. The Fed is attempting to calm inflation using tools designed for a different kind of economy. Instead of targeting the real sources of pain, housing undersupply, food system fragility, and global energy insecurity, the Fed is tightening financial conditions across the board. And while that can slow certain types of discretionary spending, it does very little to reduce the prices of goods that people can't choose to live without. In fact, in some sectors, rate hikes are making things worse. Small and mid-sized businesses, for instance, are facing rising interest on their credit lines, loans, and operating expenses that either eats into their margins or forces them to raise prices. And consumers, already under pressure, are now using credit cards to bridge the gap, at interest rates averaging over 21%. It's a financial feedback loop. High rates are suppressing affordability in some areas while inflating household debt in others. Even within the Fed, some policymakers are acknowledging these limits. In June, Minneapolis Fed President Neil Kashkari stated, "We have to be honest. Monetary policy is not a scalpel, it's a hammer. And right now, much of the pain we're seeing isn't because people are overspending, it's because they're undersupplied." That may be the most accurate diagnosis we have, and it raises a fundamental question. If the problem is on the supply side, but the Fed is targeting demand, what are we actually fixing? The effects of this economic misalignment aren't theoretical, they're playing out in real time, in households, businesses, and communities across the country. And while macroeconomic figures may suggest resilience, the distribution of pain is far from even. For millions of Americans, the system feels like it's squeezing from all sides, and relief is nowhere in sight. Let's start with renters, a group that includes over 44 million households according to the latest census data. Among them, low-income and working-class families are the most vulnerable. In cities like Atlanta, Austin, and Charlotte, where population growth outpaced housing supply, median rents have risen by 30 to 50% since 2020. These renters are not choosing to stay out of the home ownership market. They're locked out by high mortgage rates, high down payments, and stagnant wages. The result? Rent consumes 40 to 50% of their take-home income, leaving little for savings, emergencies, or upward mobility. For middle-income families, especially those earning between $50,000 and $100,000 per year, the pressure is different, but no less severe. They are caught in what economists call the cost of living trap. These are the families who don't qualify for government assistance, but also can't comfortably absorb rising expenses. Their household budgets are eroded by higher car insurance premiums, up over 19% year over year, groceries that now cost $100 more per month than in 2022, and credit card balances that are ballooning, with interest rates now averaging above 21%. According to a report by Bankrate, 1 in 3 Americans now carries revolving credit card debt, many of whom are using it for basic necessities, not luxuries. Small business owners are feeling the squeeze from both directions. On one side, customers are cutting back, deferring maintenance, reducing non-essential purchases, trading down on services. On the other, banks are tightening lending standards, and the cost of financing inventory or equipment has risen sharply. For a local bakery or repair shop, that could mean paying 12% or more on a short-term loan, compared to just 4% 3 years ago. The Federal Reserve's own Beige Book from May noted that small businesses across multiple districts are reporting layoffs, delays in hiring, or even closures due to higher capital costs. Then there are the retirees and older Americans. Many of them have followed the traditional advice: save diligently, invest conservatively, live off the interest. But in today's environment, those rules don't work like they used to. Inflation, even at 2.6%, still erodes purchasing power year after year. Meanwhile, volatility in the bond and equities markets, driven in part by interest rate policy, has eaten into retirement portfolios. Social Security increases can't keep pace with rising utility bills, property taxes, or Medicare supplement premiums. The result is a quiet but growing return of older workers to the labor force, not out of choice but necessity. Another group facing disproportionate hardship? Young adults and first-time homebuyers. Millennials and Gen Z workers, already burdened with student debt and underpaid relative to inflation, now face a housing market that is nearly inaccessible. A starter home in many cities requires a 6-figure income and a $50,000 down payment, paired with a 7% mortgage rate. According to Redfin, first-time buyers now need to earn nearly $120,000 a year to afford the median US home, up from $78,000 just 4 years ago. The American dream of ownership, long seen as a path to wealth and stability, is increasingly out of reach for the next generation. Finally, we can't ignore the rural and working-class communities across the Midwest and South, often overlooked in national policy debates. These regions rely heavily on driving, have limited access to public transportation, and face some of the highest fuel and energy burdens per household. In areas where income levels are lower and infrastructure is aging, higher prices for gas, propane, and groceries cut deeper and last longer. Local governments too are struggling. School districts, county health services, and small municipalities are watching their budgets get tighter as inflation drives up basic operating costs without a corresponding increase in funding. The common thread across all of these groups is this: the pain isn't temporary anymore. It's structural, it's persistent, and it's being aggravated, not alleviated, by a monetary policy that seems increasingly disconnected from the economic lives of average Americans. And yet, these aren't the voices that make headlines. The economy may be technically sound, but the lived experience tells a different story, one in which stability is fragile, resilience is fading, and the pressure is building quietly across social classes and geographic boundaries. Beyond the policy debates and economic indicators lies a more human truth. The emotional toll of living in an economy that feels fundamentally out of sync. Americans are tired, not just economically stretched, but psychologically strained. For many, the numbers coming out of Washington don't match the reality in their wallets, their neighborhoods, or their daily routines. And in that gap, frustration is turning into quiet despair. Lana, a 34-year-old public school teacher in Phoenix, has been working full-time for over a decade. "I finally got a raise this year," she says. "Not huge, just a step increase. But the same month, my rent went up 12%. It wiped everything out. I thought I was going to move forward. I'm not. I'm just not falling behind as fast." Her story isn't unique. In cities like Austin, Orlando, and Sacramento, where population growth has collided with housing scarcity, tenants are watching their rent outpace their income year after year. Some are forced to relocate further away from work, adding hours to their commute and more dollars to their gas budget. Others double up in apartments, delay family plannings, or leave their cities entirely. What used to be seen as temporary hardship now feels like a permanent condition of middle-class life. Jorge, who owns a small auto repair shop in El Paso, sees the ripple effects firsthand. "People are putting off repairs," he says. "They'll drive on bald tires, skip oil changes, anything to save money. I've had to cut 2 employees because revenue dropped, and I can't get a decent small business loan unless I want to pay 12%. 12? That's not growth, that's survival." He pauses, then adds, "And it's not like demand is gone, it's just that customers can't afford the basics. Everyone's on edge, we all feel it." Marissa, a single mother of 2 in Dayton, Ohio, describes grocery shopping like walking a tightrope. "I go with a calculator in hand now. I literally type in every item as I pick it up," she says. "Some weeks, the price of strawberries or chicken jumps $1 overnight. No warning, no logic, just up, and there's no one to complain to. It's like you're trying to build a life inside a moving elevator." This kind of day-to-day volatility isn't captured in CPI metrics or Fed forecasts, but it changes how people live and how they plan or stop planning. It forces short-term thinking, replaces goals with coping mechanisms, and hollows out the idea of economic progress. Tom, a retired firefighter living in Florida, says the erosion of savings is worse than the inflation itself. "We were told our whole lives, save money, don't overspend, live within your means. So we did. But now, our HOA fees went up, insurance premiums doubled, our power bill is $80 higher than last summer, same usage, and our savings, they're shrinking. We can't beat inflation with bank interest, we're just watching it all drain away." For many older Americans, the emotional weight is not just about personal finances, it's about broken promises, a sense that the social contract they upheld is being rewritten without their consent. Even among younger workers, the anxiety is setting in early. Kevin, 28, works in logistics in Chicago. He rents with 2 roommates and recently tried to get pre-approved for a mortgage. The lender laughed, he says. "I make $72. That's not nothing. But with student loans and my credit card balance, they said I'd need at least $30 down and a cosigner. So I gave up. I feel like I'm living in a game I can't win." When people say it doesn't feel like inflation is over, they're not being misled or overly emotional. They're describing something real, the disconnect between macro-level stabilization and micro-level instability. They're watching the stock market recover, the unemployment rate holds steady, and yet their own household is falling further behind. And that dissonance isn't just financial, it's deeply psychological. It fosters distrust in institutions, resentment toward political leadership, and a quiet, growing fear that this is as good as it gets. There's a subtle shift happening in the American psyche, from hope to adjustment, from trying to get ahead to learning how to endure. And the longer this lasts, the harder it becomes to reverse. The Federal Reserve has always been positioned as the adult in the room, the institution that moves carefully, speaks cautiously, and acts with the long-term economy in mind. And in many ways, it has fulfilled that role. But in this moment, the Fed's power is both immense and strangely insufficient. It can tighten financial conditions, it can cool Wall Street, it can dampen demand. But what it cannot do, and has never been able to do, is build homes, fix supply chains, or grow food. So we arrive at an uncomfortable crossroads. An economy that is statistically recovering but experientially deteriorating. Wages are rising but not enough. Inflation is falling but not where it matters. And policy, both fiscal and monetary, seems aimed at stabilizing charts rather than lives. It raises a more philosophical question. Are we measuring the right things? If inflation is under control, but half the country still can't comfortably afford rent, groceries or gas, what is it that we're actually controlling? And who exactly is being protected? Some economists argue the system is working, that lag effects are normal, that patience is required. Others say we're entering a new era where traditional monetary tools are no longer sufficient to address 21st century pressures. Aging infrastructure, climate-related shocks, global instability, and generational wealth gaps. But for average Americans, these debates offer little consolation. They're not looking for theoretical alignment, they're looking for relief. That's the heart of the tension today. The Fed may be doing everything it can within its mandate, but the pain Americans are feeling is outside the Fed's reach, and perhaps outside its design. Interest rates can move markets, but they can't bring down rent in Atlanta or build new homes in Boise. They can't lower beef prices when cattle feed is affected by drought. They can't fix a fractured supply chain or make insulin more affordable for seniors. And so the question remains, what happens when the tools we rely on no longer solve the problems we face? This moment in the US economy is less about inflation than it is about confidence. Not in markets, but in systems. And right now, that confidence is eroding. Not because people don't understand what the Fed is trying to do, but because they do, and they see its limits. We may look back on this era not as the aftermath of a pandemic or the tail end of a price surge, but as the beginning of a deeper reckoning. A recognition that price stability is not the same as affordability, and that managing the economy is not the same as ensuring dignity in everyday life. For now, the Fed walks its tightrope. Careful, cautious, calibrated. But below, the crowd is growing restless, not because they expect miracles, but because they feel forgotten. And that disconnection may prove to be the most costly economic indicator of all. That's all for today's episode. If you've been feeling the weight of rising rent, stubborn grocery bills, or the quiet squeeze of higher borrowing costs, you're not alone. Behind every policy decision, there are real lives, real trade-offs, and real struggles that don't always show up in the data. The Fed may be trying to stabilize the economy, but the question we leave you with is this: can stability on paper still mean instability at home? And if interest rates can't fix the cost of living, what happens next? We'll keep watching, digging deeper, and bringing you the stories behind the headlines. Until next time, stay informed and stay grounded.